Well, thank you everyone for joining us today. We're really excited to have this sponsored educational webinar with Zeus Companies today and Stephen Kaufman. Stephen is an amazing guest of our show uh, several times now and always enjoy the conversations. He is a deep, deep wealth of knowledge when it comes to real estate investing and long-term real estate investing. Has an incredible track record, incredible career building something that has performed very well for investors. And also I think it just aligns with their whole approach to investing, which very much aligns with ours, which is all long-term thinking, thoughtful due diligence, and making smart investment decisions in diversified portfolios, and helping investors access that in a unique and different way. Always enjoy these conversations. Today we're going to get specific on their healthcare investment vertical. And I'm really excited for this conversation because there's so much nuance in all things investing, right? And when you look at even real estate, right? Not all real estate is created the same. If we were talking about apartments, there's all sorts of dynamics going on in the apartment sector right now. But today we're looking at the healthcare sector, right? Emergency rooms. And we're looking at, urgent cares, those types of things, right? Which is a completely different style of real estate investing with a completely different profile, and all sorts of different trend lines and things going on. So we're going to get into that today. I'm really excited for the conversation. And of course, Stephen will get the opportunity to kind of tell you about some of the investment opportunities they have available. We were just catching up on a few before I came on up here. So without further ado, would like to welcome Stephen to the show, and we'll get into it. Hey, Stephen, nice to see you as always.
Hey, thanks for having me. I appreciate it so much, Chris. Thanks for having me here.
Yeah, 100%. I know many folks have probably, have started to get to know you now that we've had you on a couple of times, but just if you could give a brief overview of Zeus Companies and yourself, that would be wonderful, and then we'll get into it.
Yeah, so a little bit about myself. I'm born in New York, and I got to Texas as a child. I grew up mostly in Texas. I have two daughters, and I have been investing in real estate since Bill Clinton was the president. That's when we started making our first investments over here at Zeus, and that's primarily what we have done in the history of the company. We've done about $7 billion in transactions, 17,000 unique transactions, and focused on really three things: real estate notes, real estate, healthcare assets, and healthcare companies. Those are the three main investment buckets that we invest in. And that's a little bit about us. And I can dig into any area that you would like to hear more about.
Terrific. Well, first off, let's just take a step back. I was just mentioning this, but not all real estate is the same, right? Different verticals come with different dynamics. So can you just talk a little bit about kind of the uniqueness of working in real estate as it pertains to healthcare?
Yeah, I mean, we haven't always invested in healthcare. When we first started, that was not an asset class that we looked at. It wasn't until about 15 years ago when we were looking for the two things. We looked for the most recession resistant asset classes, and we wanted to make sure that we weren't following kind of the old hat, the old way. We want to know in the future with the world dynamically changing, what are going to be the most recession resistant and kind of what we would call the sleeper segments of the market, where that they're silently doing well in the background, and they have a lot of great upside potential that maybe everyone hasn't jumped on the bandwagon yet. And around that time, we coincidentally invested in the first legal freestanding emergency department in the state of Texas. A lot of the people who are listening probably are familiar with urgent cares, and depending on the state that you live in, you're probably familiar with what sometimes we refer to as docs in the box, or emergency rooms that are independent or freestanding from an actual hospital itself. And
Hmm.
those facilities we invest in. We actually started and invested in the first one of those in Texas, and at one point ran and sold off the second largest network of those in the city. The reason why those assets are unique is because they are, of course, incredibly recession resistant, mainly because real estate is all tenant oriented. And it's something that we don't talk a lot about when we're talking about real estate, is that everything's great except all the numbers could look beautiful, the location could be beautiful, the value add, the lift can be beautiful, but the two things that matter more than anything else, and you have to really have a secure plan for those, are going to be the sale, as in the exit, or the tenant. Because without one, though, that customer coming along, you really don't have a viable investment.
Hmm.
You have a prospect or a speculation, but it becomes a viable working investment when you have the tenant there or you have the buyer there. And what we realized pretty quickly is that in healthcare real estate, the tenants are the most sticky. We all have probably heard this if you're investing in commercial real estate, and this is factually true, and lots of groups have verified it in different ways. But essentially, medical professionals stay in their space longer than any other tenant type. So that was really important to us because renewals, move out to move ins can hurt you on the commercial side. But also, you want to look for assets that, depending on what the recession is doing, what is COVID doing, what is AI doing, which asset will perform regardless of those. And as they say, Chris, I'm sure you're familiar with this, you may have 99 problems, but when you have a health problem, you only have one problem. And with the aging population, I think by 2030, the last baby boomers will be over 65. This aging population is not the only input into the system. You also have to know that the 20 to 30-year-olds that are in our lives go to the physician and go to a doctor more frequently than we did when we were their age, and that is because of convenience and cost. It's a lot cheaper and a lot more convenient. And so when you look at different types of investments you can make, if you're going to be in real estate, if you're picking real estate as part of your asset allocation, you're picking it for all the reasons we know. It can be insured. You can use leverage. It's an inflation hedge. There are all sorts of advantages. But then where in commercial real estate or in real estate do you invest? Then you have to look at what's the most stable asset class. What asset class can I surely get tenants? They can afford to stay and they're not going to leave. And maybe they also even want to invest with us in the investment itself. If you're opening a laundromat or a car wash and you're going to rent that out to an operator, you're typically not going to get the operator to also be an investor with you. But what's very unique about healthcare real estate is we essentially partner with doctors in almost all of our investments. In fact, every investment that we have ever done, except one that we're currently doing, has only physicians as our partners. There are no other outside investors at all in those investments. So when you think about the availability of capital for those investments, that's important to us. The staying power of the tenant, that's really important to us. All of these attributes add to this perfect. I wouldn't say perfect. Let me not say perfect. I didn't mean perfect. They add to an incredible recipe of what can make a really, really amazing real estate investment.
So I do believe it's an incredible recipe. But I always like to think about downsides too when you're doing these things, right? So you're doing your diligence. A few things that come to mind when I think of the healthcare sector is first, long build outs, expensive build outs,
Mhm.
right? This is not just put up a room that someone's going to sleep in, right? It's all the medical equipment, the sanitary
Yes.
net, all these things. So there's literally the cost and time it takes to get these things up and running. And then the other one that comes to mind, and again, I don't know how thoughtful analysis this is from the outside looking in, but I just immediately think like doctor, great at what they do. Are they good business people? Are there risks with that? And who then is the operator? Is it the doctor where I worry sometimes about their like business acumen to run it? Or are they working with like a business operator and then they're just slotting in under them to provide the service? So those are two things that come to mind. How do you think about those?
Sure, those are really viable thoughts. Number one, what you're speaking about regarding the tenant improvements and the investment in the space is it's a double-edged sword because yes, for a medical tenant, you are going to invest immensely more in their tenant improvements compared to a typical tenant. When I say immensely more, that's a misstatement. Let me say you will invest. I would average somewhere between 10 to 30% more for a healthcare tenant than a non-healthcare tenant. Now, but why would we be willing to spend 30% more for this type of tenant? That's because the average tenant improvement is meant for the tenant only to occupy the space in the moment that they're there. But if they ever want to leave, if they're a massage therapist, or they are a mental health therapist, or they're an attorney, those walls are there and they can move their office the minute they move their computer on their desk. But unlike differentiate that from a healthcare tenant, like you pointed out, they're going to spend a lot more in tenant improvements to build out that space exactly the way they need it for their business. And a dentist cannot just relocate. The reason why dentists are considered the most sticky commercial tenant of any type in the United States is because they cannot just relocate all of those sinks, all of that power, all of those chairs. They need the real estate to actually conduct their business. So, to your first point, you're exactly right. Healthcare tenants will require additional tenant improvement dollars. But what you're getting in exchange for that is there in most tenants, you're paying most of the tenant improvements and the tenant's paying very little. And that's the carrot to get them in. They get to come in and operate their business right away. But with a healthcare tenant, you're typically paying tenant improvements. They're paying the same or more, and they have to invest in the equipment inside of the space. So you're creating an immense amount of stickiness for only a 10 to 30% margin increase in your tenant improvements that you're going to have to make anyway. So you have to improve the
Sure.
space. You're either going to improve it for a lawyer or for a doctor. Would you rather spend 30% more and know that that doctor cannot run his practice or she cannot run her practice outside of your real estate if she decides to relocate? That is not an easy process for them. That's point number one you made. And point number two is, are they sophisticated business people? I think we can all agree the quote, "Doctrine is money will soon part." That's an old business axiom that people know. I disagree with that wholeheartedly because of the amount of physicians that we do business with. I find them to be incredibly intelligent, incredibly well-rounded when it comes to their business acumen, and the ones that are not seem to be sophisticated enough to raise their hand and say, "Hey, I'm going to need some assistance with somebody who this is their specialty. I know mine, you know yours. Can we link together?" In fact, most of our opportunity comes from physicians, Chris, where they know this is their limitation and they contact
Yeah.
us because they either want to start or expand their real estate holdings through their practice. And they don't, I think, who's smarter, the person who thinks they're the smartest or the person who recognizes they're not the smartest and they need help? And
Yep.
I think typically physicians are pretty darn good at asking for help. So yes, you might have a poorly run business by the physician, but in my experience, most of those physicians know how to raise their hand and ask for help when they absolutely need it. um, and even us, they've asked us to help, and we have
Yeah.
helped. That's how some of these partnerships have been created, where physicians are running into either operational or real estate issues, and they are looking for assistance and guidance and partnership. And a lot of times, that's why we get brought to the table to help them.
Okay, so I had one further follow-up question on kind of like the risk side of things. So you talk about the stickiness of the tenant, and I love that, and the fact that they're kind of stuck there, like they need you. But then there's the question of what happens when they do need to move on? How hard is it to fit a new client into that space?
Well, that's also a great question, because one of the most favorable pieces of real estate that we have ever owned is what we call second generation or second gen healthcare. Because physicians do move, and that they don't, it's not as though they never move. They just have the highest stickiness of all tenants. But of course they move. And when they do, you have empty space. I can tell you right now, in most major metros, in the CBD, the central business district of those major metros that are thriving right now in the United States, I can assure you all of the second gen space is the hottest space there is.
Hmm.
Why? Because if you're a current physician and you want to relocate to a better part of town, you don't want to go through that entire experience again. You really want it done
Yeah.
for you. You want someone else who already spent that money, spent that time. So you'll go
Hmm.
into a space that's even easier to lease out, and that space gets leased a lot faster. Healthcare space, at least in the city of Houston, where obviously we have the largest medical center in the world. Um, I think we have the fifth largest business agglomeration or industry district in the on the planet, actually, in the Texas healthcare system, or Houston healthcare system rather. I can tell you right now, second gen healthcare space in Houston is one of the hottest pieces of real estate you can have. It's
Huh.
sought after. We drive roads looking for it.
Wow. So one other thing I was curious about is because you're doing these large build outs, does that enable, is there like a standard in the industry of healthcare where you get to require them to sign 5 or 10 year lease at like really long term because you have to, recognize how much money and time is going in up front?
Yeah, you're asking me really a low hanging fruit question. The bottom line is, and if you're listening to this, you really just want to hear this. And because this is information you could use and should use anywhere, whether you're using with us or not. And before I get too far into that, I did bring Chris a guide today. If you go to zeuscompanies.com/guide, and we added it as a link. If you click on more in your on your Zoom, there's a place to find that guide. Inside of that guide, it notates something that is really something that you just mentioned, and it basically outlines the criteria of the perfect real estate investment. And for healthcare tenants, and inside the guide, there we outlined these 6 steps you need, the 6 reasons why healthcare tenants are the gold standard in commercial real estate. Number one, they have triple net. This is going to address your question about how long they stay. I want
Yeah.
to just go. I want to go through the 6 because if you're listening to this, the the takeaway from this webinar at the very least should be, what are the 6 ingredients for a really great commercial tenant? Number one, it's a triple net lease, and healthcare tenants are almost always triple net. They pay all of their expenses, all their insurance, all their janitorial, all their waste, everything. So not too rare, but you have a triple net lease. Number two, something we already talked about, major tenant improvements, where the tenant is making a significant amount of their own dollar amount inside of the tenant improvements. Number three, they do typically sign long-term leases of 7, 10, 15 years. We have a lease right now for 20 years on a healthcare property. Number four, almost always healthcare tenants are pre-leased. We do not operate off of the philosophy of build it and they will come. Will they come? Yes, but that's a horrible investment strategy because it removes your predictability of the investment. And in fact, if we get a chance to talk about today, our last case study of our last sale that we just did just a few months ago, you'll understand why having the tenant when you pre-leased is really critical to turning this into a speculation, into an investment, into an annuity where if you have a triple net lease where the tenant has made major improvements in the investment in themselves, so they've invested their own money in your real estate that they have to leave behind when they go. They've signed a long-term lease and personally guaranteed it. They've pre-leased it, so there's no downtime. So there's no speculation on whether you're going to fulfill the pro forma or not. And number five, fifth ingredient, you alluded to this earlier. You want to have a lease signed by an industry leader versus, a new physician. If you have a choice, obviously, of course, you want a healthcare lease. But do you want a healthcare lease from a year one physician or, the most profitable hospital operator in America? You prefer a leading industry leader. And number six, you want tenant partnerships. And what I mean by that is where the tenant will also become your co-investor. They'll invest in the real estate. When you can have a triple net lease, Chris, where the tenant's paying all of their operating expenses themselves directly, so they have concern and care for the real estate that you own, but they are operating in. They've made significant capital investment in their own space with their own money. They sign a long-term lease. It's pre-leased. It's an industry leader. And they've invested with you. You've essentially turned this into the ultimate investment. They're your partner. They're fully responsible for it. You have a predictable revenue stream. This is the only, what we would say, real, as I say, mailbox money for real estate. This is what we just say is the only real mailbox money when it comes to real estate, other than a few other ancillary types of investments. If you're going to deal with bricks and sticks and tenants, if they're healthcare tenants of this nature, you can really create this unique situation where the tenants are incredibly happy where they are, and you are incredibly happy having them there, and they're there for a very long time, and you get to move on to the next investment, adding that to your portfolio.
You mentioned something else too that I think is really important is location, 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 right? And I am just curious, like, what are the dynamics? Obviously, there's the doctor wanting to be in that area. Maybe that's the whole answer for you as the real estate person. But what are the driving factors that you say, hey, that would be a really good spot for a medical office or an emergency center? How do you identify those?
Yeah, that's a great question. It definitely is dictated by the specialty of the physician that you're working with. Obviously, you're not going to put a plastic surgeon in the same place you would maybe put a pediatric dentist, for example. And you are right. They typically bring to the conversation areas that they're seeking. But typically, the 3 or 4 biggest ingredients that you're going to look at, number one will be what's called the patient mix. What is the mixture of patients in this geographical area? And depending on the type of physician, that you're working with, that could be a 5 mile radius or it could be a 50 mile radius. And I mean that literally. So you want to know what the payer mix, I'm sorry, the patient mix is. What type of patients do we have here? And then the second is going to be, what is the payer mix? What type of insurance? Because most healthcare professionals in the United States, right or wrong, are still working off of an insurance platform. And so you want to know who are the insurance carriers in this area. Third, you definitely want drivable traffic. What is the commuting traffic in that area? Slash rooftops is going to be, how many rooftops do we have that are in the some sort of geographical circumference from or radius from the site? Those are the three bigger ones that you're going to look at. The patient mix, the insurance mix, or payer mixes that sometimes referred to, the traffic and rooftops. When you combine those, that will, and then obviously the competitive set. Who else is in the market that's competing? And most physicians are not afraid of other competitors because their specialty may be unique to the market, and people enjoy choice. So it really is going to depend on the who's there and how long they've been here. Where are they? Are they on the main road, or are they on, in some office complex that where only the people who know them go there? Those are some of the variables that we look at.
Got it. And by the way, everyone, in the resources section, there's a button on the bottom of the screen that says resource. If you click there, you'll get that company guide that Steven's mentioning, so you could check out all the things that he's talking about here. Um, I want to ask you one other question on kind of like the due diligence front and the opportunity front. You mentioned you have one tenant that signed up for a 20-year lease. I imagine
We have more
that
than one.
actually,
We have a tenant who just signed a lease to be in our building till 2054.
like, yeah. So I imagine like that alone is a deeply valuable asset, right? So do you look when you have, opportunities like that, you're not going to hold on to this place till 2054. Does that become a really attractive acquisition piece because the business is built in for the next 30 years, whatever it may be?
Those are the type of assets that you actually look to not sell potentially unless you
Mm,
need to, because the work that you've done, unless you need the capital strategically,
yeah,
um, if you need the capital strategically to do something else, that's a different conversation. And then
sure.
you can discuss recapitalizing the project and taking some of the equity out to use somewhere else. If you don't have that need, and you are willing to invest that money and keep it invested at a very good yield, we're talking somewhere, at least on the real estate, somewhere between 16 to 24% range,
Wow.
an IRR. We have never exited an asset below 16% net IRR to our LPs in over 25 years, since Bill Clinton was the president,
Hmm.
um, um, which is when we started, 1999. And believe it or not, we've never exited a healthcare asset below 50% IRR, because typically we invest, and this is the unique attribute that I haven't even mentioned yet of healthcare real estate investing, is that in unique situations you're able to invest in the operation. Sure, the principal will allow you, and the real estate, obviously. So when you're able to do both of those with an operator you believe in, one of those is a fixed asset that has a very predictable yield. That's the real estate. It's pre-leased. They made tenant improvements, all the stuff we already talked about. But there's this other element that is the operating business. That is where a majority of the cash flow comes from, and a majority of the IRR comes from. Of every investment class we've ever invested in, healthcare investments outperform everything drastically. There's no comparison. And typically this is because there's a scarcity element involved, because most operators don't want to allow anyone outside of their business to invest in the company, as you might suspect. But
Yeah.
but there's a yoking that occurs, because when they know that we're investing in the real estate and they're investing in the operation, there's an immediate conflict of interest that occurs. Now, if you're on both sides of the transaction, and we are on both sides of the that transaction, we can think for both the operator and for our investors, and they're not mutually exclusive. What we're doing
Mhm.
for one, we're doing for the other, if we are yoked on both sides. And historically, almost every healthcare investment we've made, we're also, not all, but a majority, we're also in the operation itself, in a minority interest that typically the operator finds value in bringing us onto that part of the capital table.
Hmm. And is the reason why they raise money for the operating business because they have to do things like make large improvements and buy all sorts of equipment that's really
Yep.
expensive.
Exactly. That is the only reason. That is the
Yeah.
only reason is that they are instead of putting instead of going to get either all financing for that or they're going to have to make tenant improvements. They're going to have to get working capital for that new location, and they typically want to raise the capital for that. And in unique but unique but not totally rare, excuse me, situations, they'll allow us to participate in that, and that has been our history.
Hmm.
I mentioned, I think before the webinar that we're doing a raise for, we're almost done. We're 80% through a transaction that we're doing with the largest independent hospital or the most profitable independent hospital operator in the United States. They happen to be located in Houston, and we're
Hmm.
helping them with their fifth location. They've never raised outside capital. All of their equity on the real estate and on the operation side has all come from former employees or current and former employees. This is the first asset that or hospital they've ever opened, their fifth location, where they're allowing us to bring it to our investor group for the first time. And the
Hmm.
reason why they're willing to do that is because they want to expand and
Yeah.
and they want to grow in the future. I need to say this final point. If you look at ZeusHealthcare.com, if you look at every healthcare investment we've ever had, and by the way, it's important to note we've developed over 1 million square feet in healthcare real estate. We've never had an investment that has more than 5 partners until this one that we're talking about right now on the
Hmm.
operations side. 5 positions max on the operation side. This is the first one where we've gotten authorization to bring in outside investors, one or two, whatever we'll take to fill it up. So really unique opportunity for us.
I want to dive in on that. Just quickly, when you're talking about investing in the operating business for these healthcare providers, what is the exit path on the operating side?
The exit path is um, run it into perpetuity until we see a clear path to exit through some sort of a sale through of all the locations, because each location is its own SPV, its own entity. It's
Mhm.
separate from the others, obviously, because you don't want to yoke them in case something does happen legally. The idea is on the real estate side, how we get to at least the asset we're talking about now, we have a 21% or 22% IRR. That's through a sale-leaseback in the first 3 to 5 years. Once we build it and the hospital's operating, we will sell the real estate and we will maintain our lease in that real estate as a tenant, but our landlord will not be us any longer. It'll be somebody else. And so all of our capital that was in the real estate plus our annual return of about 20%, 22% will come back to us, and we'll maintain the hospital indefinitely. So you essentially have no capital invested in the operation or the real estate. You have no skin in the game, and you've just invested in the operating company. That's what all that's remaining. And again, that's been the most profitable investment our private equity firm has ever made in 25 years. So we find that to be a pretty valuable space to be in. And the exit plan for the real estate is a sale leaseback, again, as soon as possible. 3 to 5 years is when we predict. And the operation perpetual or in perpetuity until we find a viable buyer, either for that location or all of them. But while the operational cash flow is very strong and appears to be uh, have a roadmap to that in the future, the idea of selling can be very difficult because
Sure.
to find an alternative investment equal to that can be very, very challenging.
Tell me a little bit about this current investment opportunity, about the organization, and yeah, basically, like, what is the investment opportunity exactly? It's in this one fifth hospital, their brand new hospital that they're building in a real estate deal.
Yeah. So our partner, again, we ran the second largest independent network of emergency rooms in Houston.
Yep.
And we had always heard about another group that had a lot less locations, but was a lot more productive in those locations. And
Hmm.
if you think it's more of like the Walmart model versus the Target model, if you remember, Sam Walton opened in these kind of rural suburban areas where there was a lot of cross traffic of people coming through. Target and Kmart went inner city, and we see how that went for them. And Walmart went with this model of, instead of doing more stores, increasing same store sales was a better model. You remember
Yeah.
when Walmart added, you could get your tires changed and an oil change while you were shopping for groceries, that kind of thing. Get your check cash, all of that. So that model worked for Walmart, and they've expanded it and then brought it into the city, right?
Hmm.
Well, hospitality, our our operating partner, has done the exact same thing. They opened in these rural suburban areas where there's an immense amount of cross traffic, where people have no access to major healthcare in these small little areas, and they end up coming to these cross sections. And to give you a scope of their performance, their lowest performing location sees 4 times the national average in patients, 4 times
Wow.
the national average in patients per day. That's their worst of the 4. Their best performing location, Chris, sees 20 times the national average in patients per day, 20 times. And they've been doing that consistently for years now. And the average size of these facilities nationwide is about 6,000 square feet. Our facilities were approximately 4,500 to 6,500 square feet to handle the amount of patients that we had. Our
Hmm.
partners' facilities are on average of about 70,000 square feet, more than 10 times larger to handle the volume that is almost 20 times the national average.
Wow.
And they recognize when we met them their limitation into expand into their 5th location. They don't have the business acumen on the real estate side to keep expanding this way. And so they knew that we ran and operated a very large network of these and asked us to partner on their 5th location, which we've
Hmm.
done. And we're obviously married, and this project's well underway, just finishing up the less than 20% of the capital raise. Construction drawings are done. We're breaking ground probably in the next 90 days or less.
Wow.
And this comes on the heels of the last exit we just had, which was part of the previous network I might have alluded to earlier. We underwrote a transaction in 2018 here in Houston. We had not even heard of this thing called COVID. We thought Corona-19 was, a nickname or something for somebody who drank too much on the weekend or something. COVID and Corona were nothing we'd ever heard of. Here we are. We're going to do this hospital, what we call a medtail development, where we're going to build a freestanding emergency room along with a retail development, what we call medtail. So a retail development anchored by our own healthcare tenant. This was a 30,000 square foot retail development in the heights of Houston. We
Hmm.
underwrote it in 2018. We exited it about a month or so ago. There were only 5 partners in the transaction, as I mentioned. Every one of them at the exit made $1 million or more dollars. So everyone in this transaction became a millionaire or multimillionaire. We missed the pro forma exit price by $12,000 7 years later, a $14 million pro forma exit, and we missed it by $12,000. That's 99.1% accurate on the pro forma. We underestimated the revenue. We brought in 37% more revenue than we said we were going to project in the NOI. In the pro forma. And this speaks to something that we feel like we are uniquely good at, which is our precision underwriting. Because we're also have a debt platform, we believe that underwriting and assessing risk is one of our unique skills. And you can see that unique skill played out, obviously, with the accuracy of this last investment. And we expect to do the exact same thing with the current one that we're raising for. And we have lots of other exits, full turns from investment to sale, to investors getting all their capital back, multiple returns or exits just like that. So we have not done this just once. We've done it many, many, many times, and we can show lots of documentation about those exits. And we're pretty proud of them. And we expect this next one to be just like the past, but actually bigger and better. That's why my investment's the highest it's been. And that's why we really push them to allow other investors, including our friends and family, to invest in this one, because it helps. Not only does it help them grow for the future, it also helps us and helps our friends and family as well.
So you mentioned kind of 7 or 8 years on this last one, the last deal that you did in 2018. That's done very, very well, and that you're exiting right now. When you think about so kind of return profile, there's the equity sale, there's the operating company, and I imagine some sort of dividend payments or something of that nature, and then obviously the sale of the operating company or your portion of it. So when you think about kind of those pieces and whatever other pieces you may want to mention, and timelines, what are we looking at? What does it look like?
Yeah. So we did the reverse in this one. In 2013, I'm sorry, in 2023, we actually sold the emergency room to another operator
Hmm.
because we want to sell like anyone else, but we take this maybe more serious than the group say they want to do it. We want to sell at the premium price. We don't do a lot of transactions. We are We do not run an investment business, and that's a mistake a lot of people make about us. We're not an investment business. We make investments and then we share them with our friends and family, and if they would like to invest with us, they do. We don't have any duress or any pressure or covenant to do a deal a month or anything like that. So one year we may do three transactions, another year we may do none. Um, and because of that, we want to involve our friends and family as often and as frequently as possible. And this is one of those opportunities to do that and do it well. So it's um, I guess it's a way of saying that we're not we're not ever putting forward an investment just because we have to pay
Mhm.
employees. We have an employee of one. Our platform that runs this is a single employee who manages the assets, and then we use third parties to manage the rest of what we do. So,
Mm.
and with $1 billion in assets, you could say that we have that down pretty well, especially post COVID. As anyone in commercial real estate will tell you, we've had lots of challenges, and we've been tested again. We've been tested during the .com. We were tested during the subprime. We were tested during COVID, and I think the last 3 years have tested us again. That's why we're proud and delighted and really grateful to have new opportunities, but also exits from past ones. Back to what you asked me, in 2023, we exited the emergency room we sold, and that IRR was north to the investors. That IRR was north of 3 digits. So there was a 3 digit IRR on the operations. We decided to sell it because we feel like that was the exact time to max out the value. Because I said
Mm.
earlier, because we don't have a lot of transactions per year, we really want to do a great job of maximizing those every opportunity we get. And so we sold the operating company in 2023, and then we decided to hold on to the real estate until we thought the market would be prime. And we thought, okay, this is a good time. People are really looking for really good assets right now, in particular healthcare. Let's put this on the market. We got our exit price. We said yes, and we missed it by 12 grand, but we're really proud of the work that we did, and our investors are obviously very, 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 very thankful and very elated.
So there's kind of two parties that you have to service, right? There's the investor and finding attractive investment opportunities for them and then wanting to partake in those investment opportunities. But there's the other side of attracting great operators, right, who want to work with you. So someone like, this hospital network that you're working with right now that's the most profitable in the country, like I imagine being the most profitable hospital in the country, you could have your cake and eat it too, right? Whoever you want to work with wants to work with you. So why do they come to Zeus companies? What is your selling point to attract
Yeah.
these really attractive issuers?
Yeah, great, brilliant question. Um, the easiest answer is that we were their largest or second largest competitor. So in order to get, and I'm the
Mm.
and I was the founder of that initiative. So I wasn't the only physician, or I'm not a physician. I was not the only physician on the team, but everything from the brand to the location selection to everything that involved in their growth strategy, include in particular their strategy and their governance, came from our firm. And
Mm.
so, why did the largest operator want to partner with us? Because they saw where we took one location and built it into the second largest network in the fourth largest city in America. They wanted to understand how and what we did for that, and they want to use some of the things that obviously their model is completely different. And what you just asked me is, why would Walmart want to partner with Target or Kmart to open a new location? And the answer is because there's things that Target and Kmart know about operating, that the very nature of the way that Walmart operates, they don't know. And if your
Mm.
demographic is shifting a little bit if you're Walmart and your demographic shifting, you want to be looking at that target demographic and understanding, why are they doing things a certain way? What have they learned? And that collective intelligence, if Walmart and Target join forces, obviously they would be, they're already the biggest juggernauts retail wise in the country, and they would give a run for the money to Amazon at that point when you look at their online sales combined. So I think when you consider our unique knowledge and their unique knowledge, it's the same reason I would be seeking out the founders of a woman of our partnership group. I would be seeking her counsel the same way she's seeking mine. And in order for us to join forces, we would not cannibalize her patient base and she would not cannibalize ours. Because
Mm.
at the origin of this relationship, when she when we met, we were thinking about opening in the same location geographically. And once we both were smart enough to know, hey, we both found this same hole in the market where there's a very unique opportunity. Once we both realized that we both want to go there, it was pretty obvious that we should partner and not go there uniquely. And that's where how the relationship started.
Now, you talk about kind of having this Texas expertise and really focusing on the Texas market. The hospital operator that you're speaking of, it sounds as though they could have grander ambitions that go beyond the walls of Texas, unless there's something I'm missing. Would you ever consider continuing down the path of working with them if they expanded outside of the state of Texas?
Certainly, I think there is a huge amount of opportunity in Texas, but I would see no reason not to expand this type of opportunity in the appropriate states where the compliance is allowed for this and fruitful for this. You have some states that are more restrictive, as you know, but Texas and Florida, for example, are very business friendly states. And so there are some states that are not as business friendly. We have no reason not to expand with them as we continue to grow. And I'm sure that is part of the plan, is to grow and continue to expand after this location.
Very cool. Now, I know we hit on this kind of unique investment opportunity that usually is not available to your investors. Typically, it's kind of insiders that are already in the network. If folks are interested in this one, where can they go? And then I'd love to dive in and talk about if there are other, more traditional healthcare investment opportunities on your platform right now.
Yeah, great question. So the first thing is I would say if you're interested in healthcare investing, whether you invest with Zeus or invest with anyone, definitely download the guide that we provided. We've provided 25 years of experience
Hmm.
in a 16-page booklet about how to invest, in particular in healthcare real estate. So whether you don't whether you're going to invest with Zeus or someone else, you owe it to yourself to use this information to make an informed decision about all of your future investments. Because I think you'll see if you're going to invest in commercial real estate, this guide will really help you.
Yeah.
And it's fairly easy for us to create it. If you're interested in this particular investment, we can create what we call an investment strategy session. And that's where we
Hmm.
walk through the deck and walk through the presentation for you. That can take, 30 minutes to an hour. You get to ask questions, so forth. So fairly simple. And you can start that just by going to our website at zeuscompanies.com. Very, very simple process. And then so that's that investment. For the other healthcare types of investments on our platform, as I said, we are not a group that is constantly churning out deals. Where we as they say cherry picking them. We don't want to do unlimited deals. We don't want to be in the transaction business. We don't want to be in the fee business. We're not even running an investment business, is the way I like to say it. We are making investments that we believe are solid and valuable, and we want our friends and family, if they see that they are valuable to them, to come along with us. So I think the succinct answer is this is the only transaction that's available now. We are gearing up for another acquisition of a similar type of business right now that we're hunting for the real estate location. So this would definitely be a good time to be on our list, but we don't have the site selection yet. We've been asked to find the site selection. In the last 2 weeks, actually, we've been charged with finding site selection for a new emergency room inside the city of Houston, and we're hunting for sites, and we're in a meeting this morning about that. So the easiest thing to say about that is you want to be on our list when that's available. If you're not, you want to get the free guide, and you definitely want to be on our list. If you're not ready now, I don't think on the project I mentioned to you earlier, like I said, we're in the final 20% of that. We want to finish it in the next 30 days. We're going to break ground in the next 90 days. A lot of that is coming to a head right now. So if someone's interested in that, they'd have to move very quickly because there just isn't a lot left. As I said, 80% was taken by former employees and current employees. And there are still some of those people who've said they're going to invest, but still haven't actually done that. And that could change. And we have an obligation to fulfill their needs first because the company's model, our operator, their model is beautiful. They give as much investment opportunity to their employees, which helps their business perpetually grow because the
Yeah.
people who are there, yeah, it speaks to the volumes to their success. So I'm sorry to say we don't have anything other than the current investment and when we're prospecting because we're not always churning deals. That's not what we do.
Yep, but you should keep an eye for the exciting ones coming up. I know we've talked a lot about kind of like this emergency room, standalone emergency room setup, which is super interesting. And honestly, I never really heard of that, so I think it's really really cool. But when you look at some of your past historical successes in the healthcare field, what are some of the other, classes of building or infrastructure that you like to invest in, whether it's, single family doctor offices or whatever it may be?
Sure. We're building a medical office building, or we built a medical office building in Frisco, Texas. That's we just we're at about 65% occupancy, and we just got the CO a few months ago. So that's a medical office building that we're building. We've built medtail, as I mentioned, that we just sold, where we build a retail center, but anchor it with a healthcare tenant as the first tenant to then build everyone else around it. ASCs, if you're like surgery centers where you have gone before to have an outpatient surgery, we build those.
Hmm.
We've built those and help groups partner around them. So whether it's independent freestanding emergency rooms, or even urgent cares or physicians' offices that are inside of a retail center, medical office buildings, or surgery centers. Those are all the types of investments that we have made or are making. I didn't mention the Frisco investment as an example, or our other medical office building as an example, because those investments are already complete and we're just working them through to fruition, and crossing the finish line. So there are only two: one that we have that I mentioned earlier, and one that is coming hopefully in the next couple of weeks. And we've invested in other asset classes, and we are not we underwrite assets agnostic to their asset class
Yep.
because we're a lender, and we provide debt. So because we have a debt platform, we have what we call a multi-layered underwriting system. We first underwrite the investment like we're a lender. And if we wouldn't make a loan on this investment, there's no point even discussing it as an actual investment for our equity group.
Of course.
So
Yep.
that's how we first underwrite it. And then the second step after we underwrite it, the second layer is, all right, let's underwrite this as an investment. It made the bank money or the lender money. What will it look like if it's going to make us money as an investment? And so that makes us pretty agnostic to the asset class, but we have a high focus on healthcare assets. We have industrial assets that have done incredibly well. I didn't mention this earlier, but the second asset class that's really done well, in it, and it's not a secret any longer, though it was a secret when we first started, was light industrial space.
Hmm.
And because we happen to we live in the city of Houston, which has the largest port in the United States. If
Yeah.
After COVID, a really unique fact, after COVID, because of the shutdowns in New York and California, in those ports, if you take the LA port, the Louisiana port, and the New York port and add them all together, Houston imports and exports more of those ports, all of them combined. That makes Houston a really important hub for manufacturing and distribution. That makes industrial space really valuable here. And so we have a pretty decent performing portfolio
Hmm.
of industrial assets that are in the city. So it's another very unique asset class here, that we would recommend people take a serious look at.
Yeah, and yeah, for those who haven't joined these sessions before, Zeus Companies has a whole debt side of the platform where you could invest in their different notes and programs and have a wonderful track record there too. If you check out the Zeus Companies website, today has been specifically focusing on kind of their special healthcare vertical and diving deep on that. But there is many other investment opportunities on the platform as well. Stephen, one other thing I just wanted to ask you about, just because we have you here and your wealth of knowledge on these things. You talk about healthcare and you say healthcare very specifically. And when we get into it, right, it's really all about medical offices and emergency rooms and, healthcare services, not biotech. And I'm just curious, and I say this because when I walk down the road here in Durham, there's a building that's been sitting empty for 3 years. That was like a custom designed biotech building, and I think the funding dried up for the company, and they have not been able to lease it out. Talk to me about biotech as a potential investment asset class and some of the risks and concerns maybe you have around it, which is why you haven't built the specific vertical around it.
Yeah, this is a beautiful question. We essentially stay with the very vanilla asset classes. I said we're agnostic in general, but when we would say that we're agnostic to the asset class when we speak of the generic asset classes with the generic tenants. And most importantly, and this is in part of our investment thesis that we don't typically share, but our investment thesis has a very strong prohibition in investing in assets that are operator dependent where we don't intimately know the operator. So hospitals and emergency rooms are operator dependent. You can have an amazing asset and the hospital or the operator is not very good. This is why we say you have to bet on the jockey, not just the horse, because the horse can be amazing, but if you have a bad jockey, that horse will go nowhere. And if you have a crazy, horrible horse, but you have an amazing jockey, you might still win the race. At least you won't lose. So we believe in betting on the jockey, not just the horse. And so when you're looking at biotech, AI, co-working or shared working spaces, all of these businesses that have very difficult operational metrics associated with them, if you look closely,
Mhm.
those are investments we just won't make. It's not a if we will make them, we won't make them.
Hmm.
And that means for us, it's opportunity because we mentioned earlier the opportunity for second gen space or space that's already been built out, where we can come and buy a building or buy a space that's already been, the hard work and the heavy hammering and heavy dollars have already been spent. Those are the types of spaces that we would go look for because that biotech firm is going to leave that space absolutely beautiful. They're going to overdo it on the tenant improvements. It's going to look amazing,
Yeah.
and it'll be deserted because that's
Hmm.
where they spent their capital and their the capital they raised, not maybe necessarily where they wanted it to be spent. That does happen. I'm not saying it happens every time, but it does happen.
One last thing on just the hospital sector. It's funny because you said this is one of the most profitable or is the most profitable kind of hospital um, operating group in the country. So often, and I've never fully understood this, knowing how much healthcare costs, you hear that hospitals are not profitable. They actually struggle, right? And like need donations and whatnot. Help me understand why that is the case, and how is it that these groups, can run far more efficiently than traditional hospital operating systems.
This is a beautiful question. Partly, you appreciate the fact that when you're seeing healthcare systems raise capital from the public, a lot of times they're raising that capital on behalf of the patients. So they're just I won't speak to the inner workings of any other organization because I just don't know them. But if we take some of the biggest and largest hospital systems that are often soliciting for capital on TV, um, they're doing that because they're trying to make up for the budget, so they're not charging the customer.
Hmm.
I'm going to use the most famous one I can think of, which is St. Jude's. What an amazingly beautiful organization and what they do. And if you're not familiar with what they do, I just want to say that they offer cancer treatment for children for free, and they make accommodations for their families for free while the children are going through those treatments. I'm a father. I mentioned earlier I have two daughters. I can't even imagine what it would be like to be going through something like that. And I think to answer your question, I think what St. Jude's is raising capital for on those fundraisers is for the cost that the patient would pay, not only to visit the facility, but also the ancillary expenses like the travel, the food, the accommodations that they're offering. That's a little bit less than I would say it's less than a hospital as a business and more as a hospital as a community service. And we should all be so fortunate to support such an amazing, amazing endeavor. Um, and I'm really thankful that they do that for all the families that need it. Now, that's different than what we're talking about, which is pure for profit. And I think that's the distinction. We are in the strictly for profit mode. Like if you're going to see, an urgent care down the road, which is different than what we do. An urgent care is just an office with a nurse. We have physicians that are full time, 24 hours a day, 7 days a week. We're licensed by the same governing body that any other hospital system would be regulated by in that state. We have to have all the equipment, separated oxygen, separated water, utilities, everything else. And so the licensing burden is pretty high on us compared to an urgent care.
Yeah.
I think that was just a footnote to mention to your question. I think we're a for profit, and I think for profits, their initiatives are different than the ones like the St. Jude's that are trying to do something else just as beautiful or even more beautiful than businesses that are trying to run for a profit motive. Great question.
Sure. No, that makes a lot of sense. Well, look, this has been an illuminating conversation as always. I always enjoy them with you, Stephen, and have so many insights to share with us from your 25 plus years of experience having done this. I just want to give you the last word, again, kind of focusing on the healthcare space. What's kind of your last pitch to folks, if they're interested, what they should know about, what makes the healthcare asset class so valuable in kind of the real estate landscape of investing?
I'm going to say the last thing as candidly as I possibly can. and on the chance of not messing up the rest of the interview. And Chris, thanks so much for you and your team. You guys are amazingly professional. I'm very grateful to be here. Thanks for, always making it easy for me. And I'm really grateful. You guys are so professional. I really love being here. I think the easiest thing for me to summarize is this. Everyone is said, we've heard people say, even we have said, we never have access to those deals. That's for the good old boys. We're not part of that network. We haven't been here long enough. We don't know the right people. We this, we that. All of that gets said a lot by investors. And here we are sitting on a webinar on Tuesday, July 21st, where you are talking about an investment where we have an opportunity to raise probably now 10% of the capital raised from outside investors, because 80 to 90% of it's been taken by someone that works in the company. And we've never had a transaction where we've had more than 5 investors in an investment like this. And the last one we had like this, every investor made $1 million or more in profit. And we were 99.1% accurate in the pro forma 6 or 7 years later. When you hear all of that, to not act now about this opportunity or get our guide, you just have to question yourself next time you say to yourself, I really wish I had access to these opportunities. Because I think Chris and Kingscrowd just gave you one of those opportunities, and the timing and the generosity that you have expressed to us. Thank you. Thank you for seeing what we say is valuable to the people who listen to you and trust you. And I hope they do listen to you and trust you and get this guide and finally do something that will make a major difference in their financial lives. Thanks for having me.
Wonderful. Stephen, thank you. It's been a pleasure as always. Thank you to everyone for listening in and tuning in today. We hope to see you on future episodes of our educational webinar series. And hopefully you found this really helpful in thinking through, another way of growing and diversifying your alternative investment portfolio. It's a pleasure. Thank you again. We hope to hear from you, and definitely go check out Zeus Companies. Have a wonderful day, everyone.